Welcome all. This side Abhilash. This is the second lecture on the financial system, first unit of money banking. So let's start with the types of financial system: bank oriented and market oriented. Let's discuss what are the relative advantages and disadvantages of bank based financial systems and market based financial systems. Does financial structure market in bank based system? Banks plays a leading role in mobilizing savings, allocating capital, overseeing the investment decision of corporate managers, and providing risk management vehicles. In market-based system, securities market shares center stage with the banks is getting society saving to firms, expecting corporate control and easing risk management. The unresolved debate about whether markets or bank-based intermediaries are more effective at providing financial services hampers the formation of sound policy advice. Next, components of financial systems. So we have six components for a financial system: financial services, financial instruments, financial institutions, financial intermediaries, financial markets, and financial regulators. So financial services provided by asset management and liability management companies. They help to get the required funds and also make sure that they are efficiently invested. Example: banking services, insurance services, and investment services. Financial instruments are available for short term and long term investment, like derivatives, future option, forward, debt funds, corporate bonds, convertible bonds. That all are the financial instruments. Financial institutions. Financial institutions are acting as a mediator between investors, are acting as a mediator between the investors and borrowers. Financial institutions are acting as a mediator between the investors and borrowers. They provide financial services for members and the clients. It is also termed as a financial intermediaries because they act as a middleman between the savers and borrowers. The investor savings are mobilized either directly or indirectly via the financial markets. They offer service to organizations who want to raise funds from market and take care of financial assets like deposits, securities, loan. Financial markets, the marketplace where buyers and sellers interact with each other and participate in the trading of bonds, shares, and other assets are called a financial market. Like example, share market. Financial assets, the produce products which are traded in the financial markets are called financial assets based on the different requirements and credit seekers. The securities in market also differ from each other. Financial regulators like SEBI, who is regulating the stock market of India, then IRDA, who is regulating the insurance business. We have RBI for banking system. These are the some of examples. These are the some of examples of financial services like fees-based advisory services like stockbroking, credit rating, corporate services, capital market services, portfolio management services is called as a PMS as well, underwriting, custodial services, investment advisory. Asset-based services, bills discounting, consultants, factoring, forfeiting, housing finance, hire purchase, venture capital funding, insurance, leasing, and consumer credit. Next are the financial instrument. So in this column, you can see that in term market, we have a short term and long term investment opportunities. These are all the financial instrument. In the short term instrument, we have a money market like treasury bills, T-bills, CDs like certificate of deposit, commercial papers, in debt. In the short term period, in the equity, there is no instrument available, but in derivative you can trade in option features and forward contracts. Why? Because in all these three contracts are having the expiry date which expire by the month end. In the second row, there is a LT. It's the meaning of the LT is a long term. So in the long term means we can invest in the capital market. So we have one more financial instrument in the capital market like corporate bonds, corporate government bonds, corporate debentures, convertible bonds. In equity, we have a common stocks like in stock market, you can invest in the equity. preferred stock are also available, hybrid investments also available in there, and in derivatives, lips and swaps can be done. So let's discuss all these debt and equity in detail. So financial instruments, first equity, common shares and preferential shares. The common shares are which is available in the stock market, and the preferential shares are those. Preferential shares, more commonly referred to as a preferred stock, as shares of a company stock with dividends that are paid out to shareholders before common stock dividends are issued. Foreign equity like ADRs, we have a currency for trading. Euro equity also GDR. Next, next financial instruments are government securities, corporate securities, foreign bonds. Government bonds is a debt instrument issued by the central and state government of India. Issuance of such bonds occur when the issuing body, that means central and state governments, faces a liquidity crisis and requires funds for the purpose of infrastructure development. Government bonds in India is essentially a contract between the issuer and the investor, wherein the issuer guarantees interest earning on the face value of bonds held by investor along with the repayment of a principal value on a stipulated date. Corporate bonds are issued by the companies, private companies. Corporate bond is a debt. An investor who buys a corporate bond is effectively lending the money to the company in return for a series of interest payments, but these bonds may also actively trade on the secondary market as well. Corporate bonds are typically seen as a somewhat riskier than the US government bonds, so they usually have higher interest rates to compensate for this additional risk. The highest quality bonds are commonly referred to as AAA bonds, which the least creditworthy are termed junk. We have foreign bonds like Eki bonds, the used by non-US entities, samurai bonds, bulldog bonds, and Shinshui bonds. Euro bonds are like dollar, yen, and pound bonds, which are effectively available from the foreign countries. They are lending money from the Indian people. Next, convertible bonds. A convertible bond is a fixed income corporate debt security that earns interest payments but can be converted into a predetermined number of common stock. The conversion from the bond to stock can be done at a certain time during the bond's life and is usually at the discretion of a bondholder. As a hybrid security, it is a hybrid security actually. The price of a convertible bond is especially sensitive to change in interest rates, the price of the underlying stocks, and the issuer's credit rating. A convertible bonds pays fixed income interest payments but can be converted into a predetermined number of common stock shares. Second, convertible preferential shares. Convertible preferential stocks and shares are preferred shares that include an option for a holder to convert the shares into a fixed number of common shares. After a predetermined date, most convertible preferred stocks in exchange at the request of the shareholders, but sometimes there is a provision that allows the company or issuer to force the conversion. The value of the convertible preferred stock is ultimately based on the performance of the common stock. Convertible preferred stocks is a type of preferred shares that pays a dividend and can be converted into a common stock at a fixed conversion ratio after a specified time. Convertible preferred stock is a type of a hybrid security that has features of both debt and equity arising from the dividend payment and conversion option respectively. Warrants are a contract that gives a right but not the duty to buy or sell a security, equity before expiry at a certain amount, most usually equity before expiry at a certain amount. The price at which the underlying security may be bought and sold is called the exercise price or the strike price. The Indian and American warrants may be executed at any time on or before the expiry date, while European warrants can be exercised only on the expiry date. Warrants giving the right to buy a security are referred to as a call warrants. Those giving the right to sell the security are known as a put warrants. Next, financial instruments. So financial instruments we will discuss in the upcoming session. So we will stop here on the financial instruments. If you have any doubt, you can connect with me personally. You can call me as well. Thank you. Best wishes.